Hello there. I'm your host, Justin Bogard, and this is the Real Estate Note Investing Be the Bank broadcast. Today is Wednesday, February 11th, 2026. We have Mr. Jay Benoit and Dan Deppen on the call today. And nothing really special on the show today. It's more of discussion, maybe some debatable topics that we'll have on here. And if you are on any platform watching this live, please chime in. Let us know where you're at. And if you have any questions that we can answer on the live stream, we will definitely do that. Sit back, relax, and stay tuned. Here they come. Hello, my friends. Happy Wednesday.
What's up?
All right. So before we went live, Jay was telling us about he's in Mississippi because I didn't realize, how bad the ice was down there. So give me a little bit of sense of kind of what the weather was like down there because I'm in Indiana.
Well, right now it's fine. This was a couple weeks ago. And so when that real bad ice storm blew through from Dallas all the way up to the Northeast and it got real cold. So northern Mississippi, all of Tennessee, northern Alabama, a lot of North Carolina, all the way up, just had some serious ice issues. Yeah. And we finally thawed out to the point where the major power outages are mostly addressed at this point. There's still some people without power, but a lot of tree damage, so much tree damage. I mean, it really looks like a hurricane or tornado blew through, and it's just cleanup. That's all it is.
Wow. And did you have some at your house? Because you're in Birmingham, right?
In Birmingham is where I live. And no, we were lucky. The weather pattern was weird that particular week. We had a tornado warning in the south of Alabama, which kept the ice north enough of us. So we didn't have anything at all, really. No ice, no tornadoes. It was actually a very nice weekend.
You're in that little swath of area that didn't get affected then. Yeah. Lucky you, huh? And Dan's out there in Denver, and he hasn't hardly got anything remotely bad, right?
Denver's like pretty much skipped winter this year. I think we've gotten snow, like appreciable snows, maybe like twice. And,
I can't hear Dan for some reason. Justin, can you?
I can hear Dan. Yeah.
I can't hear him. I hear you. I don't hear Dan.
Huh.
That's weird.
That is weird. But yeah, I can hear Dan just fine. Sorry. I don't know how to solve that one.
I have no idea.
That was tricky. You might have to log into YouTube on your phone or something so you can hear Dan.
You can be our interpreter tonight.
You have a ASL licensing where you can do the sign language, Dan?
No, I can't do that. I can make stuff up, but no, it's not going to go.
Yeah, the middle finger.
No.
That reminds me of I always forget when it comes to the Super Bowl and they have the before activities and they do the different anthems and stuff, and then they always have like a person signing. I was thinking like that's how do you learn how to sign, like signing? It seems like it's even another 2 or 3 layers of difficulty on top of just signing itself. So
I heard something very interesting about signing as well the other day. You would think that sign language is universal across the globe, and it's not.
It's not?
No.
I would have thought so too.
Yeah.
Well, I guess that makes sense because some words can't translate. So there's a sign language for specific dialects?
Different languages.
Different languages?
Yeah.
Huh.
Thought that was fascinating.
That sucks. So if you learn sign language in one language, then that doesn't work in another language.
Right.
So, all right. Well, anyways, thanks for getting on the show today, guys. So I didn't have anything in particular lined up. I just more or less had some questions. So I know Jay's you kind of leaned more into the hard money and real estate property aspect of the real estate world. Dan is obviously a note guy, and he also leans more heavily into underwriting now that he has a company called the Underwriter. And I primarily am a seller finance person as well, and I'm more in the investing, buying, selling than I am originating. So we kind of got a nice blend of different people on the call today to talk through some things. So my first thing I wanted to talk through is underwriting and due diligence. I don't know if either of you saw a post that I posted like maybe a week ago, and I was talking about how they're not the same and they're actually different. And a lot of people in our business use those terms interchangeably. And so I was trying to kind of define quickly in a post, like what it means to me for underwriting versus due diligence. And you require both, in my opinion, to go into a deal, and they both have different use cases, right? So for my view of it, it's like due diligence is like collecting the documentation and just verifying that things when you're buying a note, for example, things are enforceable, things are, legal, and you have like, a chain of title and just, kind of completing a checkbox. And then the underwriting is more of like the artistic part of the deal of pricing it, right? It's like looking at the borrower's pay history and understanding, like, are they stable with this? Do you see some inconsistencies? And then knowing how to price based on all those risk tolerances that you discover in due diligence and like the underwriting. So I don't know if you guys agree or disagree with that, but I just wanted to hear your thoughts on it, or if you had a different way to look at it.
Yeah, I guess I never really thought about the definitions too much. I've kind of, I guess in my head, kind of, those are different things, but I've kind of lumped them all into the same process. So I think what you're saying is like the due diligence is like collecting like the hard data, and then the underwriting is like the actual like pricing and assessing risk level and matching that with your risk tolerance and that kind of thing. Yeah, I mean,
yeah. Jay, did you have anything to?
Yeah, I don't know what he said, but
oh, sorry, I totally forgot that
I was watching this video to see when he was finished talking. That's about the best.
Yeah, hopefully you can lip read. Yeah.
I do kind of have a little bit of a background there. I have originated quite a few loans, some mostly in the hard money space, but I've done about 40 loans in the consumer world, and I did call the Underwriter before Dan became patron there. And you're right. I guess there is a lot of due diligence that goes along in that process, before you can actually do the underwriting. So there are two separate things.
What does it look like, Jay, when you are getting, if you are getting a hard money loan on a deal? I know sometimes you can raise private capital and you do different ways that you do that. But if you're getting a hard money deal from just like a, some sort of institutional lender, like what type of underwriting scope are they kind of drilling down to find out, like, hey, is this what he's presenting to us? Does it make sense for us to lend on this?
Everybody's going to be a little different because everybody's got their different standards and guidelines and boxes and whatever they got to check and so forth. I would say primarily where most investors or hard money lenders are similar is that they're going to be lending you 50 to 70%, maybe some are even higher, call it 80%, of the after repair value of that property. So that's going to be your total max loan. And then they're going to either, depending on what kind of sophistication you're dealing with, they're going to give you the rehab funds and you have the funds, and you just do the work and don't have to worry about draws, or they're going to hold the rehab funds in escrow and you're going to do draws, and you're going to make inspection requests to get those draws released over time. That's kind of the, I guess, thing that ties all of us together in unison. There's going to be a whole lot of differences as to how we underwrite it. what valuation we place on that property. For example, I'm super, super, super specialized in my market. And so I know my values very, very well. I don't really have to get an appraisal. I don't really have to do a whole lot of deep dive into the value of a property when it's fixed up, because I know those houses. I've personally fixed and flipped over 1,500 of those houses in Birmingham. I know the cost of materials. I know the cost of construction. I typically know what an average repair cost is going to be. So what I really need to see is the purchase price, and I need to see the scope of work and some pictures that go along with that property to let it tell me the full story of what they're going to do to that property, because not every investor is going to do the same level of renovation to each property to get it to a certain level of value. So you've got to assess all those different things. The national guys are going to be a lot more scrutinizing of the property and the investor, whereas we're really just going to be looking at the property more so than the investor. We do ask the questions around the investor, but it's not as much of a concern for us as it is for the national guys.
So you're a borrower and a lender in a sense?
Yes. I don't borrow as much anymore. I do hypothecate my loans. Mm-hmm. So in a sense, that way I am still a borrower. But I'm not flipping houses anymore. I've stopped that about a year ago or so.
Jay, we got a question that popped up here. I don't know if you can read that on the screen. Can you read it?
8 properties. A lot of them are under 100K in Kansas. Possible to get a portfolio loan? Yes. You can do a DSCR loan for all 8. Be glad to talk to you about that and introduce you to the right people, get you in the right room where they can help you with those things. In fact, a lot of people struggle with single family rental refinances because the valuation is not there. So a lot of these properties are sub 100,000, and many of their people they know, their lenders and financial networks and so forth, don't want to lend on that type of asset, whether it's the valuation of it or whether it's the location or many different things. But a DSCR loan is going to allow them to refinance it based on the rental amounts. And if you can portfolio them together to get a larger valuation, as opposed to $100,000, you got $800,000. That's much more attractive to those DSCR lenders, and that's what they like.
What do you call that? Is that a blanket loan? Is that what the loose term is?
A portfolio loan.
Portfolio loan? Okay.
You can use blanket loan, but usually they say portfolio.
Okay. Nice. Hopefully that answers your question. Not sure the person's name. I just see their handle up there. Yep, they said thank you.
Got it.
Mr. Benoit. So Dan, I got a question for you. And obviously, Jay, you can answer this too. And I know Jay won't be able to hear Dan's answer, so I'll have to quickly summarize it for you. But I get on the fence about this, and I know there's other things that I look into it, but sometimes I just go off the hip on this decision, and it comes down to the size of the down payment. And I've purchased loans, and I'm not afraid to admit it, where a borrower has put down 50% down payment on, let's just say it's like $110,000 property sale. And I was okay with no underwriting on that particular deal because I think the collateral looked like it was pretty solid. Like it wasn't in what I call like a traditional like working class neighborhood, but it was in more of like disrepair. But I've also seen really high quality houses with really low down payments. And I'm like, yeah, that's still a little bit too risky. I really want to see some seasoning on it. So I didn't know if you have any sort of down payment indicator for performance. Like, I don't believe it's a real indicator of performance, but I didn't know if you had a thought of like, hey, is there like a break even point on that to where he's like, yeah, if they put down 50%, I don't really mind whatever else is going on.
Yeah. I mean, that's an interesting one. I mean, in general, kind of the way I view it is kind of like a belt and suspenders, right? So if they have a bigger down payment, they've got skin in the game, they're more likely to pay, or, then you also want them to be credit worthy. But really, like when I make a loan, I really just want the borrower to pay. And then like the equity that they have in it, that's like my fallback, right? So it's kind of like a belt and suspenders approach. I mean, a 50% down payment, like it's hard to go too wrong because unless something's like really crazy with the property, like you'll be able to get maybe if you need to. That doesn't necessarily tell you much about their credit worthiness as a borrower necessarily. Like a lot of the wholesale lenders, the two big things that they wheel on are LTV, which basically means down payment, and then credit score. So it's like a little bit of a balancing act too, right? So like the amount of down payment that I would be okay with will also be a function of the borrower's credit. If they've got sky high credit, I'm okay with a smaller down payment. If they've got worse credit, I need a bigger one. So it's a tough thing to give kind of like a point answer to. I would say as far as averages of what I see, like, so for owner occupied seller finance loans, most of the down payments are like in the 8 to 10% range. And that's pretty good. If you can get 15%, you're like in the top tier. You don't see a lot at 20% plus, although you do see them. But a lot of people create loans with like 3 to 5% down payments. And I feel like that often gets kind of sketch. So,
yeah. Jay, I'm assuming you didn't hear any of that.
Nothing.
Okay. He described it as belt and suspenders. So he's like basically saying that the larger the down payment would probably mean that it was a worse credit score. And if it was a better credit score, he's willing to kind of lean closer to like maybe the 15 to 10% range on down payment. But yeah, he agrees that there's other indicators, when you put down a large down payment, that sounds great. And if you're a rehabber, you might not care if you get the property back because you're like, yeah, that's just my other tool belt that I put on. And that's, a common lane that I can handle. But most of us don't want to do that anymore. And so we prefer to have other indicators to say this is going to perform.
I would add something else to this.
Okay.
And it's only because I've been around this kind of product for the last 20 years. And as a contractor and as a flipper and an investor, as well as a property manager and a whole bunch of different hats that I would wear over the last 20 years, especially in this neighborhood of $100,000 and less is what we're talking about specifically.
Okay.
Maybe it's 150 where you live. Maybe it's 200. You can kind of fill in the blank. But if it's the sub market, the lower end market that we're talking about, and somebody's put down 50% of the after repair value and the loan is on the other 50%, you really need to make sure that it's an arm's length transaction between the buyer and the seller. And you need to make sure that property is in an appropriate condition to be valued at that particular dollar amount. Because you may see something along the lines of an investor coming in and lipsticking the outside to make it look decent, selling it to somebody for twice the value of that, and saying they received half the down payment, and really it's 100% financing. So these folks can get creative like that, and especially if they're not using an underwriter. Now, Dan, if they're using you and you see that they put the legitimately money is transferred, that might make your mind be a little bit more at peace. But you need to check that value of that property, and if you can get some interior pictures, things like that, it would make me feel a lot better, especially if it hasn't been seasoned very long.
I'm imagining, the Blazing Saddles movie where they have like the movie theater front of the house, and it's just like two large 2x4s holding it up, and
I've seen
taking pictures from the outside. Oh, that's a great looking house.
I have seen people do that. I've seen people take pictures of after repair pictures of these houses, and it's a different house completely. And I've seen them take pictures of an air conditioning unit that was installed at a property, only to know that the next day that air conditioning unit went to the next house for the next set of pictures. I mean, you've just got to be very, very careful in the low end world there.
I don't remember who told me this and who exactly it happened to, but I was like third hand information from this, but I believe the person that told me. But they said that when they looked at this note, it was supposed to be a performing note, and they bought it, and the house looked decent, and they took a picture from the front and kind of like a 45-degree angle on one side and the other side. And they had this note, and something happened like 6 months down the road. And lo and behold, they sent another BPO agent out there. And when they went to the back of the house, it was completely missing.
And
I was like, I don't know if I would ever catch that, because most BPOs that I get are just looking at like the house itself on the front or looking down the street. Like they're very, I don't know if the word is lazy, but it's like whatever their quality control measure is, they typically don't take the effort to get like more of
the reality is, Justin, if something like that's happening, getting by you, somebody committed fraud,
Oh yeah.
That's definitely what's happened.
I've only heard that. Like, I don't want people to think like this happens all the time. Like it was one time out of the few thousand deals that I've seen. So it's unlikely it'll happen, but it's just, you always remember the things that are the worst, right? Mm-hmm. And that's what helps you be a better investor, because you don't make the same mistake twice. Well, some of us don't. Some of us still learn the hard way.
Hard head.
Yeah. Dan, do you still see a lot of people creating balloons when they create owner financing right now?
Yeah, I still see a reasonable number of those. I encourage people, if you're talking like an owner-occupied seller finance, I encourage people not to do that. But yeah, I still have clients who do that, and sometimes people who want to do that. When I ask them why, I think sometimes it's just it can be because they come from a background in hard money lending, and it's just kind of what they're accustomed to. Like, you make a loan, there's a balloon, so you get paid back. Or if I ask them, like, what's your intent with that loan feature? It's usually like, well, I want to get liquid at some point. And so what I tell people is, if you create a really tight loan and you got all the T's crossed and I's dotted, well, now you can go sell that loan to a bank and get top dollar. So you can, if you create a good enough loan, you can cash it out anytime that you want. So I refer to that as like anytime balloon, right? So now I can get liquid like right after I originate it. Like, I had a client a while back, got an offer 98 cents on the dollar, like on a newly originated loan from a bank. So if you do it right, you can sell it any time you want, and you don't need that feature. Because the other things people need to consider too, if it's an owner occupant who can't get other financing right now, how are they going to pay off that balloon in 60 months? Right? Like, okay, are they going to, maybe they have a plan, they're going to like fix credit and be able to refinance. If they don't, but like if they really make payments for the next 60 months, they're like, hey, I can't refinance this balloon. Are you really going to foreclose on them at that point? Probably not, right? And I mean, people say, well, if that happens, I'll just, mod the loan, we'll keep it going. I'm like, well, in that case, why don't you just create a fixed amortization? Just take the balloon out if that's what you're going to do.
Exactly.
Anyhow, comes to it. So yeah, because it is a balloon on an owner occupied loan is what they call a high risk feature. So they also just kind of smell bad if the loan ever gets scrutinized. And there are some rules around it. Like, you can have it in there, but they have to be at least 60 months out. Sometimes people want to put them like 18 months out. And I think that just comes from like a hard money pattern.
Yeah. So Jay, he was saying, he's still seeing a lot of balloons on owner occupant loans, and it's kind of like a high risk type loan for owner occupied ones. And he's saying the minimum is about 5 years out, but when someone isn't qualified to go get bank financing and they're getting seller financing, what's the likelihood they're going to be able to pay off the loan when it comes time for the balloon to pop? So his philosophy is the same as mine, which I'm sure it's the same as yours, is just fully amortize the loan. You can still do whatever you want with it, sell it, chop it up and sell it into pieces, sell participations in the cash flow. Like, there's different ways to sell a loan. It's not just like, I have to wait till it matures. So that's just what people think about loans when they create them, I believe, when they don't have the, education that we do and the experience that we have in this field. So hopefully they can listen to conversations like this to know, like, you don't have to worry about balloons, like making them as like, oh, hey, in 8 years, you're going to pay it off. Well, how do you have a crystal ball? And you get that little 8 ball, you shake it. Like, are they going to pay it off in 8 years? Please try again.
Well, statistically, they probably will.
In 8 years, I can see that not being an issue. But I think the 5-year window, you start to question, like, I don't know if they'll really be able to pay it off or not. Now, they may sell the house and pay it off. That's easier. But are they bank financeable in that future timeline? I don't know. the ITIN buyers are more than likely probably not going to be able to make that window. So,
yeah, although there are an increasing number of I-10 borrower non-QM lending programs from some of the wholesale lenders, but yeah, we'll see.
How often do you see, Dan, an I-10 buyer that actually has a credit score or profile?
It's, gosh, I'd have to run the numbers to see. My guess is it's probably, I guess, in like the 50% range.
He said 50%.
Yeah. So, a lot of times with I-10 borrowers, like they like to do everything in cash. So you'll run credit and you'll see like no open credit lines and there's basically no credit score. That's not a bad thing. That's actually vastly superior to bad credit. So what we do is we'll add loan conditions and say, hey, show us examples of a couple bills you've paid, for 12 months. So it's not a bad thing credit wise, but yeah, you do see that quite often.
Yeah, he's saying most of the time you don't see them have any credit because they pay cash for stuff, so they don't really have a credit profile. So a borrower like that actually is better than a bad credit borrower,
right?
And I'm you know that, Jay. And that's what Dan was referring to. So this is fun getting to duplicate your efforts.
Mr. Yeah, you're like a sure you listen, Justin. Yeah.
There's an echo. Jay's like, I only heard it once. Everyone else hears it twice. Okay. So I was trying to think of other questions to ask you. I just had one and I spaced it. Is there anything going on with either of you right now that was interesting that you ran across in the middle of a deal or about to get into a deal that you thought was worthy of bringing up as hey, watch out for this because I just noticed this?
Yeah, I had one lately. Had a client where the borrower, we were trying to get all their information to underwrite the loan, and they were kind of slow rolling. And then he was coming back saying he was having problems filling out other things and things weren't right. And it didn't really make sense. We couldn't figure out.
So the borrower's filling out an application, and when you were
he was filling out an application, and then we sent him a loan estimate via e-sign, which he signed, and then we got to the point of sending the closing disclosure. And then he said he couldn't e-sign it because his phone number was wrong, but we had it right in the system before and he couldn't figure out. It's like, well, you e-signed the other one. Why couldn't you do this one? And he was telling the lender, hey, the Underwriter system's all screwed up. This doesn't work. And the lender was getting mad at us. And I was like trying to figure out like what in the heck was going on with this. And I couldn't figure it out. Well, it turns out the borrower was in the process of getting another loan in addition to this one. So this particular
on the same house?
On the same house.
Well, let me catch up, Jay, real quick because I don't want to lose the thought. So Dan is underwriting this guy. He's filling out his application. It comes to e-sign it, and he's like throwing up a red flag like he's unable to, even though he provided Dan the right phone number to do it. And Dan's now getting ready to explain like he's discovering that this borrower is involved in getting another loan on this property. So
yeah, so what he, and I'm not quite sure how the lender like came to know this, but basically he was slow rolling and he was trying to get these two loans at the same time. So neither one would see the other record and then he would get loans. So what that kind of leads into is sometimes if the borrower gets what we've learned, and like around Christmas time, I was going through a bunch of data from last year. Like basically if the borrower takes more than about 3 days to get you all their information, then either the likelihood of the deal falling through kind of shoots through the roof. So either the borrower is going to have income or credit problems, and maybe they're trying to slow roll, hoping the lender gets impatient, which, creative finance investors are very impatient. It's not hard to get them impatient, right? And trigger. Or sometimes too, they've just like they're under contract, but they no longer want to do the deal and they're hoping everybody just gives up on it. So my kind of message to lenders is if your borrower is taking more than a certain amount of time, it tends to be kind of a red flag that something's up. You should probably just go have like a heart-to-heart conversation with them and see what's up.
Dan wasn't sure how the original lender that was using called the Underwriter knew about this other loan happening, but because Dan was sniffing out the fact that there was starting to be like a time drag, and that time drag is an indicator for him to know, like, if they're slow rolling me, there's something going on, or they're trying to escape the deal, get a reason to get out of it, or like this guy was trying to commit mortgage fraud where he was trying to get two loans. Hopefully neither lender knew, and it would just get recorded like within a day of each other, and no one would be the wiser. And he was just trying to collect, obviously, two large incomes against one property.
I've heard that happening recently.
And recently you have?
Mm-hmm.
Yeah. Interesting. I'm not surprised that it's happened, but it's like another thing that lenders like us have to be aware of. Like, people are just going to try to find different ways to be manipulative and work the system. And this comes down to when I talk to newer people in the business, I like harp on them. Like, if you're not tight with like your discipline on, like, you start with step 1 and you go down the line to step 20, like if you miss a step, you are opening yourself up to a liability that you may not see for many years down the road, but it's going to hurt you real bad. And, we've all done stupid stuff and we've made mistakes. And so I want to make sure I pass along that info to them. So it's not easy just to say out loud what they all are. It's more of a practice of going through the whole process from step 1 to step, whatever. But my screen just switched to dark. Do you guys have the auto light and dark settings on your computers?
Mine stays the same. Yeah.
Okay. I hate it. I want it to stay the same, and I always forget to change it, but it just happens where I'm at. It's 6:30 on Eastern time, and it starts to switch to nighttime now. So now everything just went dark, and I'm just trying to figure out, like, what happened here. So it takes me a minute to focus on where my notes are at. Escrow. I love it when there's escrow in a deal, but I'm also not going to turn away a deal because it doesn't have escrow. But it is a thorn in my side to keep track of which loans don't have escrow that I buy. And I don't know if you guys care which way or the other when you buy notes. Jay, did you have any thoughts on that?
I'm just creating notes, so I don't buy notes anymore. And everything I do is pretty much in streamline and exactly the same. So it's simple and repeatable. But I understand what you're saying because I had that concern and problem at the beginning.
Yeah. So you're pre-filling that escrow account at closing, like they're putting a couple of months of taxes proration and a full year premium prepaid.
Well, with the hard money stuff, we're really doing this so fast. I'm not collecting any taxes anymore. Okay. And I am asking for a 1-year prepaid insurance policy to be done. So I don't have to keep up with any of it.
What's the maturity average on those loans? Because I assume it's less than a year because you don't need to collect taxes.
The paper's 12 months. And so when they buy it, we'll make sure that there are no taxes on the property. And when they go to sell it, even if they didn't pay their taxes or if they refinance it, we'll still be able to take care of that. In Alabama, they have 3 years without any kind of legal recourse. So it's pretty
plenty
easy.
Of time.
Yeah.
They put an daily interest on that? Yeah,
they get interest, but you don't have to go in front of a judge to get this resolved. You just go to the tax assessor's office, and the people that buy your taxes may be a little bit of a difficult individual or group to work with, but it's not hard.
In Indiana, it's 2 years. Deppen, what's it in Colorado?
I don't know, actually. I've only done like one deal in Colorado, so I'm not sure.
He doesn't know. He's only done one deal in Colorado.
And even in Alabama, we can go past 3 years. I can take him to court, and I can still get the property back all the way up to 7 years.
I didn't know that about Alabama. I don't think I've had a note in Alabama or property, so this is interesting to learn. Yeah. What's your take on escrow? Mr.
Yeah, I mean, I'm kind of on the same page as you, Justin. Like, if I'm buying a note, I strongly prefer it if they have escrows. I'm not going to walk away if they don't, but it's always a pain. It seems like whenever they're not escrowed, we always end up with delinquent tax bills and that kind of stuff, which I've changed. My approach on delinquent taxes has evolved over time as well. I used to be like in a hurry to pay them because I was just worried about them getting away from me.
Yeah.
Now I just kind of let them run, and I don't really pay them unless I absolutely have to. And if I do, then I'm foreclosing, like at that point. So
Dan's in line with how I was saying about the escrow and up front. He's not too worried about paying them when they start to become delinquent. He used to be, and so now he's just letting them ride until he needs to take care of it. I actually get a lot of pushback. I use FCI Lender Services on a lot of my loans, and when it becomes to defaults on taxes or getting ready to pay taxes, like they're up my butt about getting it paid before it becomes delinquent. So I pushed back on it before, and they don't like that. So it's like pretty much like, hey, we'll go ahead and deboard this if you don't want to pay it, type of thing. Which I get it from their perspective. They're trying to follow a rule and a discipline, but that's when I get irritated with the borrower. So it's like, oh my god, like now I gotta wire $150 to this account because it's due in 15 days. I'm just like, come on.
FCI's done that
as a consumer. I've had many servicing companies that I've had to deal with, and I really liked FCI the most.
Yeah.
And as a consumer, you have no choice. You just got to, go with it. There's been some horrible ones out there, but FCI was good.
Yeah. What were you saying, Dan?
Yeah, and I actually like the way they handle delinquent taxes. Like they've done that to me too, and it's kind of annoying. But what's nice is the way they handle it, right? Like I pay FCI, they pay the taxes, but then they do a real good job of collecting that back from the borrower. Whereas with other services, like I have to do a lot of keeping up with things
with interest.
Yeah, and make sure the account gets credited. So overall, like I like the way FCI handles that process.
Yeah, he likes the way FCI does it too. Yeah, you talk for 2 minutes, and I summarize it in 2 words.
This reminds me of, Justin, when I was back when I first Oracle and did international travel, I gave this presentation in China through an interpreter. And I would like give this long-winded thing, and he would say like one sentence, and then I would say like 2 sentences, and he would go on for 5 minutes. And then I realized like I wasn't giving the presentation at all.
He was saying how he was given a presentation in Chinese, and he had an interpreter, but he was like saying something, very long-winded in our language, and then the interpreter would say something like, 10 words, and he's just like, really? That was it? Did I paraphrase well enough, Dan?
No, that was good. Yeah, basically I realized like what they were doing was just saying like, you're an important customer. We flew a guy from Colorado out here to talk to you. That was like the whole point, not what anything I had to say.
Reminds me of the Ace Ventura bit, Ace Ventura 2, when he's you guys seen the movie Ace Ventura?
Yeah, he's like, did he refer to me as White Devil?
Yeah.
Yes.
I'm sorry. You refer to me as White Devil, White Devil? Yes. This is how they know you. Leave that part out. Okay, White Devil. Oh God, I can go on forever with those movies. Okay.
You asked earlier, Justin, about what kind of what do we learn? Going through a deal, and I'll say that one that I kind of have been exposed to, even though I was encouraged to really pay attention before I did it anyway. And I know some states you have to do it this way, but a contract for deed, bond for title. So if you sell in that direction versus selling for a note and a mortgage, you are still the owner of that property until they pay you off. So you legally on courthouse records, you're the owner. And so I had a buyer that was being industrious, I'll say, and decided that they were going to move on a manufactured home onto this piece of land and continue to build up more manufactured homes all around it without going to the county or the city and getting permission. I'm the one on record. So the city comes knocking on my door pretty hard. The county comes knocking on my door pretty hard. And I had to tell them, I'm like, this isn't me, y'all, But I had to sue this particular buyer to stop them from knocking on my door before they started suing me.
Wow.
And we eventually got it gone, but it took a long time to clean that up. So
that contract for deed reminds me of something I wanted to ask. So thanks for bringing that up. And so I got mixed, I guess, counseling on how to properly insure the contract for deed, because if you're the owner of the property, but you sell it on owner financing via land contract or contract for deed, How do you guys think the property should be insured?
I continue to pay that insurance as it's a rental.
So you get a landlord policy?
It's still in my name.
And then they get renter's insurance policy?
Right.
How do you do it, Dan?
So normally I have the borrower gets their own insurance, but I'll get liability insurance because I'm on the deed. That's how I was told to do it. But that's,
so that makes sense.
Could be off, but yeah. I'm not 100% on that.
Dan gets the liability insurance for his side and has them get their own insurance on it. So that makes sense to me, logically speaking. And I actually didn't even realize this until not too long ago. And so that seems like it's the right way to do it. But I had always seen when I bought a lot of land contracts that the borrower had a true homeowner's policy, that the property was insured and their belongings were insured as well. So I'm wondering if the insurance carriers just don't look into the fact of what the instrument is.
They will only look into it when there's a claim made.
Yeah.
And when they see that you're not an owner of record, they're going to be saying they're not going to pay you.
So I have had a couple of different people that have bought loans from me that have land contracts in, houses have caught on fire, and the insurances are still paying out to the loan servicing company for them to pass on the check to the buyer. So I don't really know what's going on. I think it's just big confusion for all parties involved.
I had one do that. I had one that was in Indianapolis that burnt to the ground, and the borrower had their own insurance policy, and they paid off, and then they sent money to the servicer, and I got paid off on the loan. But I'm sure mileage varies too, depending on the insurance company and where it is and all that.
It's just another reason to not do contract for a land contract, because it's just another carrot hanging out there that you're just like, oh God, another reason for the attorney general come after me or somebody come after me and say, hey, you're the property owner.
And I know a lot of people are doing these contract for deeds where they wrap on a subject to mortgage. I mean, talk about a headache. I just wouldn't want any part of that.
Yeah, I'm sure Dan sees way more of it than I do. But when those conversations pop up, I say, hey, if you say the word sub two, like I'm removed from that transaction completely. So you put me on another property that has a note on it, but the one that says sub two on it, like I'm not even bothering looking at it. Mm-hmm. Dan, do you see a lot of sub twos?
Oh yeah, I do. Yeah, we do a lot of those. I mean, from an underwriting perspective, it doesn't change the way that we do things because they're just creating a new loan. But yeah, we do see quite a few people doing those. So
what's your Dan says he sees a lot of people doing them. He says from an underwriting standpoint, it doesn't matter because they're just looking at it as a new loan. So my question back to Dan now is, I don't know what the true legalities are on this, but do you have like a stance, like your firm is like, hey, I'm just underwriting this borrower for this loan. Like I'm not involved in any of this Ponzi scheme going on here with the sub two.
Yeah. I mean, from our perspective, we're not really involved with the close and the transaction. It's more, we're saying like, here's a report on this borrower for the new loan. As far as sub twos itself, I've never done one myself, but I've been deep diving on that over the last year. So having not done one firsthand, which is a huge caveat, I'd say there's ways to do it correctly. It's just, there's more moving parts. It's more challenging, and it's, like everything with notes, it's very unforgiving.
Yeah.
If you do it wrong. So it's kind of like hard mode. I wouldn't say like, don't ever do it, but really like have your stuff together, if you are. And a lot of people doing them don't have their stuff together sometimes. So
he's saying a lot of people that are doing them don't really have their stuff together, but he's obviously encouraged people like, hey, you need to, check this out to make sure you're doing it right. I'm not taking any responsibility for this, obviously, but he's still underwriting it because it's just treated as, hey, I'm just adding a service to making sure this borrower can pay on this loan with their DTI and all that stuff.
That's all he's supposed to do.
Yeah. Mm-hmm. So I was just curious. I didn't realize how many that you see. It sounds like you see them quite often come through.
Oh yeah.
That's pretty much their only exit other than renting. And most of them don't want to be a landlord. So.
Mm-hmm.
Yeah.
they don't have a lot of money to do it. I don't know why they're messing with this stuff. It's going to break them.
Yeah. I just, I see some of the people on Facebook that have like a really good marketing program to talk about these things when they're, I think I saw somebody do like an actual live call, like when they were on Facebook and doing that and talking to the person that was still holding the mortgage and selling them the house on the property to say, hey, if you just, allow me to make the payments for you. And I'm just thinking like, man, like you got some huevos to, think like this is going to be like, I get it. Most people have the best intentions of like, yeah, I'm honestly going to pay it to make sure like they don't get hosed on their credit and stuff. But it's just like, man, I wish people were smart enough to realize like that's like, letting your daughter go out on a date without understanding who it is, the person that's taking your daughter on a date. It's just like, that's pretty risky.
Yeah. And I would say too, like if you're doing that, when you create the new loan, like all things being equal, my standards as a lender need to be higher, right? Because it's already a nightmare. If you have a potential nightmare, if you have to go through foreclosure, if you've got an underlying lien, you got to pay on, like the price is that much higher. So
absolutely. Jay, he said that you're the most handsome guy in that room right there.
I own this room, baby.
Yeah. That's what I say to people. I go, you know what? You're the best looking guy in that room. And
at least you can hear both sides. This could get real weird. Like this.
Yeah. Yeah. Dan can hear everything, but you just can't hear Dan.
I'm at a disadvantage here.
Yeah. Right on, guys. Well, hey, this was fun call today. Thanks for hanging out and answering some of these funny questions. We didn't have too many comments on the board today, so we don't have to reflect on, besides the answers that you gave, Jay, to our friend there in Kansas. So thanks for watching live. If you're watching the replay, you can still leave comments if you want, and I can follow up with you and answer your questions. Jay, you mentioned that you could help out our friend there. Is there an email address that I could type in the chat real quick that they could get a hold of you?
Yeah, jbenoit@virgofunding.com.
Let me type that, JBENOIT at Virgo.
virgofunding.com.
Funding.com. Perfect. All right. There, I sent you his email address at hard107. So you can connect with him and he'll help you out with finding that DSCR lender. That's what it was, right?
That's right.
Awesome. All right, gentlemen. Thanks again for the call. We will see you guys March. I don't know what the date will be. It will be the second Wednesday in March. And hopefully this was helpful to somebody.
Hope so too.
All right, guys.
Thanks.
See you.
Thanks, guys. Good night.
Bye.